Building on what we said in the last video, uncertainty on the lower time frames prevails and it isn't going anywhere soon. Supply lines are fractured. The Middle East is at war. The world is sitting on an edge. What you do at a moment like this defines you. Do you panic or do you read the room? Because if your psychology is not prepared for moments like these, you will lose. There is no other way to put it. Not might lose, will lose. And this is not about this war or that war. Wars are just the mechanism. The real story is always the same. Markets wiping out millions of unprepared people, panic buyers and panic sellers on both sides, and a certain class making generational wealth from both. That is not new. That is the oldest story in finance. This is why we push out data every single day. Reports, numbers, primary sources, everything you need to interpret the situation on your own terms, according to your own goals. Nobody knows your financial goals better than you. Nobody knows your fears better than you. So identify your shortcomings. Address them. Be brutal and objective. No one is coming to save you. Period. Make yourself so prepared that you become the person others look to. If you cannot sit through 10 minutes of data a day to understand what is happening in the world, this channel is probably not for you. It never will be. As for me and my team, if this helps even one person make enough to cover their groceries or pay their bills, that is the win. Don't call me a legend or a goat. Or best case scenario, don't even acknowledge me. My goals are different and so are my wins. Coming back to what I said in my last video, patience is still the edge. Everything that landed in the last 24 hours reinforces exactly that. The vault drain data, the Shanghai picture, Jane Street, Venezuela, Poland, oil, Iran, the jobless claims. Let's get into it. Silver is at $82 Western spot as I record this. It came off 84, touched 81.90, and is still consolidating. The lower time frames are weak and unclear. I am not going to dress that up. I said the same thing yesterday, and I will say it again. I would not touch this right now. Full stop. If you are adding leverage on top of that, that is a separate problem, and it is yours to solve. But while the paper price sits at 82, Shanghai futures closed at $96, Shanghai spot at 94. That is a $12 premium. Let's build the picture from the ground up. The Shanghai Futures Exchange shed another 22 metric tons of silver in a single session Thursday. 710,000 ounces pulled from SHFE vaults in one day. Total SHFE silver inventory now sits at 8,768,000 ounces. Silver closed on the HFE at 97.54, up nearly 2% on the session. Gold closed at 5,192 on the same exchange. Platinum at 2,543, palladium down slightly at 1,929. The Chinese market is not pricing silver the way the West is. That divergence is not a glitch. It is a signal. Separately, the Shanghai Gold Exchange reported February withdrawal data that stopped me mid-read. 115 metric tons of physical silver withdrawn in a single month. The 8-year seasonal average for February is 62.5 tons, nearly double. And when you combine January and February together, SGE withdrawals have reached 436 tons, a record high for that period in the entire dataset, more than double the same window last year. The SGE vaults also shed 13,155 kilograms in the single week of February 23rd through 27th alone. That is not demand. That is a scramble. Layer COMEX on top of that. 3 million ounces drained in a single session on Tuesday. Metal out of Asahi, Brinks, CNT, IDSD, and MTB simultaneously, with hundreds of thousands of additional ounces adjusted out of registered status across 3 more custodians. Registered silver now sits at 87 million ounces. Total inventory at a fresh 1-year low. And COMEX open interest has crashed to 112,874 contracts, the lowest level since 2013. The paper gamblers are walking out. A casino that loses its players loses its power to set the line. SHFE draining, SGE draining, COMEX draining, all 3 simultaneously, east and west. That is not a coincidence. That is a structural story about physical silver leaving the system at a rate the paper price is refusing to acknowledge. Now China's gold picture, because this adds another layer to the same thesis. 2 of China's big 4 banks, ICBC and the Agricultural Bank of China, have investment gold bars listed as sold out on their apps right now. The Bank of Communications is not even offering them anymore. Beijing retail shops are selling branded gold at over 1,600 yuan per gram. The institutional and retail physical gold market in China is showing the same stress signal as silver. Demand outpacing supply, paper price and physical reality diverging. While the paper gold price in Western markets trades around $5,096, the physical picture in Asia is pricing something different. Now let's talk about Jane Street. Covered this in depth last videos. Go watch it if you haven't. Everything is broken down there. Here's what's new and what ties it together. Position value has grown to approximately $1.6 billion in equity, but sitting on top of that, call options on nearly 40 million underlying SLV shares at $2.5 billion, put options on 43 million shares at $2.7 billion. The options book alone is over $5 billion, more than 3 times the equity stake. This is not a firm that bought SLV because they think silver goes up. The underlying position is the tool. The options book is where the money gets made. And here is why the pattern matters. Implied volatility doubled from the October highs while price was simultaneously rising. Rising price should compress fear, not amplify it. Someone was building massive options exposure into the move, profiting from volatility itself, not direction. Short interest was rising through the same period even as price moved higher. Borrow rates, which hit 20% during the October squeeze, stayed abnormally low. Shares available to borrow were at multiples of October levels. Rising price, rising short interest, collapsing borrow costs, exploding implied volatility, all at once. That combination does not happen in a clean market. The custodian of SLV through all of this is JP Morgan, the same institution that paid $920 million in 2020 to settle 8 years of precious metals spoofing charges. Settled federal case, not a theory. What matters today is the structure hasn't changed. It has only grown. Now, let me widen the frame. Because while all of this is happening in metals, the macro forces pressing against the same pressure point are stacking up fast. Venezuela. The Trump administration has brokered a deal to import up to 1,000 kilograms of gold from Venezuela's state-owned mining company, Minervan, with Trafigura shepherding the metal to U.S. refineries under a separate government arrangement. The contract calls for 98% final gold content and could exceed $150 million. 1 metric ton. The first ton is moving. The pattern forming here is pointed. In a world fracturing into geopolitical trade blocs, metals are being redirected along political alliances rather than open markets. A country sitting on hard assets is trading physical gold, money that has held value for thousands of years, for paper dollars that will keep getting debased. Venezuelan gold first. And the analysts watching this closely are already flagging what comes next. Mexican silver sits in the same strategic geography. If gold flows along political lines, silver may follow the same path. Watch that space. Poland. The governor of the National Bank of Poland proposed selling down a portion of Poland's 550-ton gold reserve, potentially generating approximately $13 billion, to fund defense spending, as an alternative to the EU's Loans for Weapons program that has drawn U.S. opposition. The proposal was presented directly to the Polish president. There are legal barriers, and the prime minister backs the EU route, so this is not a certain outcome. But the moment it hit the wire, precious metals sold off. That is what the market does with potential central bank supply. Whether it materializes is genuinely unclear. What it tells you is that the market is sensitive to any supply signal right now, and your position sizing needs to account for geopolitical surprises that have nothing to do with fundamentals. Oil. WTI is trading above $78 as I record this, the highest level since January 2025, up roughly 35 to 40% from December lows. But here's where the energy picture gets genuinely dangerous. Iranian forces have already struck key regional energy infrastructure in the past few days, and senior officials have publicly named $200 per barrel as the likely consequence if the conflict escalates further. The Strait of Hormuz still carries roughly 20% of global oil consumption and a similar share of LNG trade. Map the inflation math. Even a sustained move to $108 per barrel would add approximately 0.5 to 1% to Eurozone headline inflation. At $200, a named explicit threat from a named adversary that has already demonstrated willingness to act, that is not merely an oil shock. That is the onset of a second major inflation wave while central banks have barely tamed the first. Layered on top, Qatar's LNG facility is offline following strikes, with restarts potentially weeks away. Coal futures surged over 8% in a single session as markets pivoted to fuel switching, and Putin has publicly floated the immediate rerouting of Russian pipeline gas entirely away from Europe. Oil, LNG, pipeline gas, coal alternatives, all under simultaneous pressure. Korea's Kospi surged 9.6% today in a sharp rebound after a historic sell-off. But zoom out, and the picture is different. The DAX is down 2.5% on the day. S&P is down. NASDAQ is down. Bitcoin is down. Risk assets are broadly selling off while physical metals are draining globally, and energy infrastructure is under genuine threat. The market is not pricing optimism right now. It is pricing stress. Now, The data that hit today and what it means for your plan. U.S. initial jobless claims came in at 213,000 against an estimate of 215,000. Continuing claims at 1,868,000 against the estimate of 1,845,000. Slightly better than expected on initial claims, worse than expected on continuing. The read-through was immediate. The dollar caught a bid, and paper metals responded by moving lower. Silver dropped from 83 to 81.90 in the session. That is the mechanical correlation. Nothing changed in the physical market with that number. The vault drain continued. The SGE withdrawal rate didn't slow. But paper markets price the dollar first and physical reality second, and that is the environment you are operating in right now. This is where I need to stop and talk about psychology. People expect straight lines. They buy silver at 80, expect 100, and panic at 82. That pullback is not a verdict on your intelligence. It is noise. Markets have never moved in straight lines, and they never will. Then there's FOMO. Silver runs from 80 to 86, and suddenly everyone who missed it needs to buy at 86. No entry logic, no exit plan, just the emotional need to not be